Welcome, everyone. Welcome to this week's Crashes and Taxes. We have a lot to cover, but I still think this will be a pretty quick podcast. So hopefully you can get this done in less than 25 minutes, and I'll give you your time and you'll get some great information. This podcast is going to be a little bit different because I'm going to really implore you to not only take action for yourself, but to actually take action for people that you care about that are in your life, your friends, your family, your colleagues, your coworkers, your church group, social groups, whoever is in your groups. I think that this is a great podcast to send their way because I think this affects everybody. So let's go ahead and get started with this week's podcast. I'm recording this on March the 14th. My producer produces it. This came out before the SVB collapse on March. It came out last week. And basically what Jerome Powell was pointing out in front of Congress last week was that the U.S. banking system is sitting on about $620 billion of unrealized losses. And that's because they have assets that have been devalued, that they had basically acquired before all of the interest rate hikes of 2022 and 2023. And so what that means is that as you buy something that has a fixed rate of return and then interest rates go up, your value of that financial instrument goes down because it's no longer paying market interest. So if I buy a bond that's paying 5% and then the market rate goes to 6%, my $100 bond that I bought at 5% is no longer worth $100 because what the market is going to do is discount that $100 below $100, let's say to $93, so that my effective yield on a bond that is a stated yield of 5 becomes 6. In other words, your fair market value gets discounted down to bring the effective return to the market level of 6. So anytime people have fixed income instruments, which are bonds, those bonds always go down in fair market value as rates rise. Now, you can hold your bond to maturity and collect all of the 5% interest that you agreed to get when you bought your bond for $100. You can still do that, but it doesn't mean that your balance sheet of your fair market value of all of your assets has not been impacted. And that's exactly what this article is talking about. Banks in the United States have about $620 billion of value of financial assets that have gone down by that much. They have gone down $620 billion. Now, this is not a nothing number. To give you a perspective on that number, the FDIC Insurance Depository Corporation has about $200 billion of assets to backstop our banking system. So you can understand the massive implications we're talking about here on these unrealized losses. Let's keep going. Let's talk now about Silicon Valley Bank. I want to read this to you. Institutional investors hold a majority ownership of SVB, which is the investment bank, through 99.12% of outstanding shares that they control, which is higher than at almost any other regional bank. In other words, SVB, Silicon Valley Bank, was really a regional bank that was owned by other institutions. And we're going to look at those institutions in just a second. SVB Financial Group, which is SIVB on the NASDAQ ticker symbol, is owned 96.77% by institutional shareholders, 1.85% of SVB Financial Group insiders, and 1.38% by retail investors, with the Vanguard Group itself owning over 11%. Let's look at the actual breakdown of these shares. Let me make this bigger. Let me see if I can make this bigger. Well, you can't, it's not that big on your screen, but hopefully on your screen it's more readable. You can see that here we have Vanguard Group owning 10.85%, SSGA Fund Management 5.2%, BlackRock over 5%, JP Morgan Investment and Management basically almost 3.67%, Artisan, Harding, Franklin, Mutual Advisors, Capital Research. Those are our top 10 ownership of SVB Bank. So for those of you that don't really know what SVB Bank is, it is a venture capitalist bank. It's a bank that was based in California, has branches other places, even international. Bank based in California to really work with the venture capital, private equity, world space. And what's really happened with SVB, I think, and the reason that they were kind of on the forefront of the beginning of this situation is that they were a venture capitalist bank. And so basically they would get a lot of funds for their clients once the client IPO'd or initial public offering. So venture capitalists, obviously the whole goal is to buy up firms, they actually saddle them quite a bit. It's kind of like, it reminds me of SNL days of the 80s, but they saddle them with a lot of debt to leverage up their productivity. And then they so like, let's say they were operating at a capacity of, let's say $20 million of expense on a yearly basis. They'll leverage up the debt to maybe $35-40 million on an annual basis, but that will then hopefully double their capacity, double their production. So they leverage up debt in order to really bang out production, and then they push the IPO. The IPO then basically IPOs, the debt either gets, it could be, convertible debt, but usually the debt gets paid off, and the capital comes into the original investors, and they get substantially a nice return. So the company, once it IPOs, has so much cash flow influx from the initial sale of the shares of the equity of the company that they are able to live off the IPO for a good operational period of time. Now, what has happened with specifically SVB Bank is that because the IPO market is looking so much worse in the last 18 months because of the economy globally and all the things we talk about on this podcast every week, a lot of IPOs have not happened. So a lot of these VC funds are having to basically live off their own cash flow, their own bank accounts. And we know a lot of these startups are negative cash flow. They're not in positive cash flow territory. We've had a lot of IPOs. So many come to my mind: Uber, Beyond Meat, so many in the last 2 years or 3 years, I should say, that have IPO that have negative interest, that have negative cash flow. It's a new phenomenon. In the last 10 years, it's never really been a thing, because the way that you price a company is to discount at a certain discount factor their future cash flows. So when you have a company that's got negative cash flows, that is very hard. And what you're ended up doing is you're actually ending up projecting positive cash flows at some point and then discounting that back and finding the IPO valuation from the beginning. So this SVB Bank basically had a lot of clients that were not able to get outside funding, and they were really having to self-fund. So they were living off of their bank accounts. They were really, managing and operating from their current bank accounts. And that basically meant there was a lot of withdrawals and a lot of lack of liquidity. People are using down their balances, they're spending down their balances. And that means SVB can't make out new loans. That means SVB can't service existing loans. It means the collapse of a bank. And as we've been discussing here, and certainly I don't want this podcast to be hyperbolic, but I am doing something different with this podcast, which is I am imploring you to actually take action, because as everyone else in the market, and let's just talk about the market. Today is Tuesday, the day after the collapse on Friday. And right now we can see that gold is at $19.1070 an ounce. Silver is at $22.025 an ounce. They were both up 5 and like 3 and 6% yesterday. But the market today is up. The Dow is up right now 0.42% at 132. NASDAQ is up 1.51% at 168 to the upside. And S&P is up 1%, 40 points to the upside. So we also see Bitcoin today is up 1628, was up actually earlier to by about 2,000, was up almost 8% in just one day. The volatility index was up about 15% on money on trading on Monday, when about 20 regional bank stocks got halted on trading, and so did Charles Schwab. But today it is back down about 8.37%. So basically the market is feeling it feels to me like the market has, for right now, acquiesced to what the government did yesterday when President Biden came out in the morning on Monday morning before the markets opened and said that everybody will be made whole. Now, that was a tell to me. And the reason that was a tell to me, and you can see here that our money supply is negative, gone to the negative year over year, January to January. And this is what I've been talking to you guys about. The liquidity drying up is going to be the death now for the economy. So right now, to me, the markets are showing on Tuesday that they are okay with what has happened with SVB, and that they are okay and accepting the government's response, which I would say would be bringing the equivalent of bringing a tank to a gunfight, between two individual gun owners without any kind of semi-automatic, or just a regular gun that's not semi-automatic. They're bringing a tank to that gunfight. And so the first thing that we know is we have been told and forewarned by multiple groups and a lot of deep analysis that a bail-in is what's going to be on the radar for 2023 as the financial transition happens. The fact that they came out and so quickly with the tank said we're going to bail out not only up to the 250 level, but we are going to make depositors whole on SVB. That was like shocking. That was like, what? And it was a big tell to me, because first of all, they only have to insure up to 250. Second of all, we know the average balances at SVB were over $2 million. So you're talking about commercial accounts, some companies that are Chinese-based companies that are trying to do venture capitalist things in America had their accounts with SVB. The American taxpayer, the FDIC, and of course, Biden said that it wasn't going to come from any taxpayer money, it was going to be bank fees. But I can just tell you right now, bank fees do not equate to the amount of bank losses. It's never going to just be bank fees. It's not even a possibility. So it is going to be FDIC and beyond, and it's a big problem. So what I am analyzing and assessing is the fact that they came out and were so massively, Congress, Federal Reserve, the Treasury came out and were so massively, we're going to make this right. No one's going to lose anything. It's going to be fine. That tells me the system, and this is where I want you to remain calm for what I'm going to share with you, and prepare to take action. The system is the beginning its collapse. But they are not yet prepared to move forward with their bail-in, which is the freezing of all accounts. They're not yet prepared. There's a couple of things that are still needing to be put into place where they are prepared then for the bail-in. And you have to remember, this is an international scope of operation that we're talking about. So international things could also be holding up the freezing of the system. So why they're going to use a cyber attack internationally originated by China or some other nefarious group to say, oh, the whole system is frozen and it's going to freeze. That's the bail-in that we've been discussing. We know that is what the FDIC is planning for because of their public November 2022 meeting, where they basically didn't even want to discuss their bail-in parameters because they didn't want to create a bank run. So what I am assessing and the information that I'm analyzing, what it's saying to me is that there is going to still be a bail-in, but it will occur after a blackout or cyber attack of some kind. It will be a massive attack. It will affect the entire United States, among other countries. That's when the bail-in will happen, and they will usher us on and move us towards digital ID and central bank digital currency. But they are not exactly ready for that yet. And yet the system is beginning to collapse. So they had no choice but to come up and say, everything's going to be fine. Let's stop this right in its tracks right now, because they are not yet ready for pulling the trigger on the bail-in. So that is why we're getting this massive bailout beyond FDIC limits, even with commercial, accounts, on Monday morning, on March the 13th. So we can see that the liquidity is drying up. We can see it here from this chart. We know that they are going to bail in. And so my professional advice is a couple of fold. The first thing that I would say is that you need to absolutely take this seriously. And what we want you to do is call our office. If you've been watching the podcast for over a year and you've never called our office, I don't really leverage the podcast as a way to get business. However, I am so concerned with the transition that we are about to go through that I want to talk to as many podcast viewers as possible. And when I say me, I mean my team. Obviously, I have a very decent sized team, you guys, of managing all these accounts and all these clients, plus what I do every day, which is a ton of research, so I can make sure that I know what's going on. And when I say I mean my team. We want to analyze what you have, where you have it, and we want to help you very quickly, in very short order, rearrange things to prepare yourself for what we're about to go through. There are some things that can be done to prepare. I don't want to be ever a cause of any instigation of trouble, but I will just tell you that I have no confidence in the banking system at this time. And I would have really minimal dollars in the banking system except for to pay cash flow bills. So I would maintain cash flow balances for right now, meaning that you just need to have in what you need to be able to spend the next 2 months. But beyond that, I am looking to have those funds out of the banks, not because the banks are having issues, but more because it is going to take a lot of time, a lot of patience, and there's going to be quite a bit of issues as we come back to the new way that things are going to be. So what I'm saying to you is that give us a call this week. As soon as you hear this podcast, call our office. The phone number is 866-92-WEALTH. 866-92-WEALTH. That is 866-929-3258. 866-929-3258. Just say that you listened to the podcast this week and that Rebecca implored you really for the first time to call the office to set up an analysis. And anybody that calls the office and sets up this analysis, we are going to give you a free Morningstar report, a free Riskalyze report. We will assess your portfolio. We will assess the current risk on the standard way. But we will also start to tell you the opportunities that you may have to protect yourself into bridge assets while we go through this transition. I am telling you that the transition has begun. And that doesn't mean that it's going to go from March to collapse instantaneously. They are doing everything they can to keep to their time frame, to pause the disruption that's organically occurring and make it to their time frame of the event and a bail-in. However, the best laid plans, the system is collapsing organically. So I don't know how their plan with what is actually happening, boots on the ground, is going to come together. But what I can tell you is this is no longer like not known. Here is Jerome Powell literally speaking last week in front of the Senate Banking Committee. And this is a Senator Cynthia Loomis from Wyoming, where she's basically calling Powell out and saying that a constant credit creation system, a system that has to rely on stimulus and low cost of capital. When you take away the stimulus and you take away the low cost of capital, the system will implode upon itself. And this is really the stage that we are arriving to now. And so while I think it's very important that the world remain calm, I think we can calmly decide that we do not want to be a part of this system as it goes down this road, because there will be losers and we do not want to be one of them. I want to quickly turn to a few other things that are happening just to keep your top of mind. We have Binance, which is probably the second largest crypto exchange in the world. And Binance took some really interesting moves. This is end of February, but they moved $1.8 billion of collateral, which was meant to back the stable coins. And they basically invested in hedge funds last year. And hedge funds didn't do great last year. They really shorted the market. They expected the market to sell off. The market did sell off, but the hedges didn't do super great. But that's how they made money. And it just shows you that this is the same thing that FTX did. They monetized their assets underneath their line pool of assets into a stable coin or a coin. And then the assets were to back up the coin, and the coin's value borrowed to be traded. Well, what they did was they donated assets, they spent assets. So the stable coins really had nothing backing them up. And then here we have, interestingly enough, Binance doing $1.8 million to the same tune that they did. This is Silvergate. Silvergate is a crypto bank. I actually used Silvergate when I was dealing internationally with my international MBA. So it's a very big international crypto bank that does a lot of things. That is liquidating, and there's several other banks that have obviously began to liquidate. We have a ton of financial shenanigans in the economy. This is a really great article that goes into what is going on with the fraudulently. But here's the CEO of AMC Theaters, which is a meme stock, just like GameStop. And you can see that many of you and we, this is Adam Aron, who is the CEO of AMC. Many of you and we are aware that AMC Entertainment has been on the threshold list for 3+ weeks, indicating a number of FTD's failure to delivers. Some of you may be pleased to learn that we have contacted both FINRA and the New York Stock Exchange, asking that they both look closely at the trading of our stock. This is the part of the financial shenanigans that is happening. This is related to the Wall Street Bets group on Reddit, as well as Wall Street Apes, that tweets out every day publicly to Gary Gensler, who's the head of the SEC, that AMC has been shorted so much that the average CTB cost to borrow is over 250%. It's gotten up almost to 1,000%. They have millions of shares that have been shorted, meaning that a hedge fund shorted the stock, betting that it would go down. But because of the Wall Street Bets Reddit group, these investors are sticking together like a pool, like a block, and they're not selling. So the stock is not dropping as the hedges expected it to drop. And so what's happening is it's making the borrowing cost to borrow a share when you short it extremely high. Like I said, it's almost gotten to 1,000%, but it's been averaging 250. And so they are not borrowing the stocks, which creates an FTD, a failure to deliver a borrowed share. And when you have, and this is 25% of their total stock is being failure to deliver. It's a massive number. It's putting them at number one on this threshold list where something is not trading and acting correctly. You've got the CEO of AMC calling this out publicly via Twitter to FINRA and basically the SEC through the NYSE. So this is what we're talking about as far as shenanigans that people are looking at. They're looking at the dark pools. They're looking at the buying and selling and market pressure being erased and moved off exchange so that the institutional money can kind of have its way. The other thing that's really going on, Gordon Chang is the chief Chinese expert at Fox News Corporation. And he tweeted out on March the 8th that he expects the Chinese military will be the cause of the blackout. You can see right here, he says the Chinese military will take down our grid, turn off our water, and spread disease. CCP, which is Chinese Communist Party saboteurs, will detonate bombs to terrorize. We have left ourselves vulnerable in our own homeland. Now, the biggest point of this is he's saying that a war with China will be fought on American soil. The reason I'm bringing this to your attention is obviously this is relevant to right now and the escalation potentially between Russia, Ukraine, the Chinese helping Russia, just like NATO's been helping Ukraine. It's a proxy war getting to be a war between three global superpowers, Russia, China, against the United States, which is a huge problem for us. We lose that battle with those two ganged up against us. Hands down. I don't care what anybody says. You can only have so many nukes that can only destroy much of the earth so many times. So yes, we can destroy them, but they can also destroy us. So 2 against 1 is never a good recipe, certainly when it's Russia, China against the United States. The reason I bring this up is because we had intelligence and analysis back in 2021 and 2022 from people in China that were telling and reporting that citizens were being told by the Chinese government that they were moving from a peacetime to a wartime and that they were going to war with the United States. They were the government that was locking people down even up until last year in 2022 when they had still their zero COVID policy, were telling their citizens that they are going to a physical war, not just electronic, not just, a physical war, tanks, boats, launched physical tactical war against the United States of America. So the fact that Jordan Chang, who has got massive Chinese connections, is coming out and publicly tweeting that they will attack us on our soil is alarming. And again, anything that escalates, our system is so flimsy right now as a recovery post-coronavirus that any escalation of any kind will be massively detrimental. The other thing I want to remind you is we have really good jobs numbers for February. They came out again to the upside, more than beats. And what I can tell you is that's the small and medium-sized businesses. These are businesses like mine that have been hiring for the last 3 years constantly and straight, because large Fortune 100, Fortune 500 businesses, they are massively laying off. We just got another alert that Meta announced another 10,000 layoffs today. I think Meta is reverse course and going back to the bare bones minimum. I don't know if Meta is going to actually make it, which is, I think not. I think a lot of the techs are going to be lost through this process. So we have massive Fortune 100, 500 job layoffs. We know the small and medium-sized businesses are being very resilient and really still driving the job growth, which puts Powell in a really difficult spot because he wants to keep tightening. But the market pretty much believes the day after Monday, March 14th, the market is believing that we are fine and that the Fed is now going to pause or stop altogether their rate hikes, and that 50 basis points completely off the table. If we got anything at all on March 22nd, it's going to be 25 basis points. This is what the market believes. And this is because the market just has really no comprehension or understanding of any way of what actually is where we're at. So crashes and taxes has been through an evolution over the last 2 years and really since 2020. But what I would say to you now is it is not time to just think about doing something. Now is the time to actually take action. I want you to actually call our office. We will give you free analysis that's worth usually probably, well, it doesn't matter. It's very valuable information. And you'll have one of the people on my team, one of our financial advisors, to give you options of bridging where you currently are to where we're going, because this is not over. This has just begun. And so far the market is accepting that the government's going to handle it. But as we know, we never expected it to be a bailout. That is happening because the system is collapsing too fast now and they can't stop it. So we will expect, based on the fact that this has already begun and they're having to bail this out when they didn't want to do bailouts, we would expect that this will push faster, if at all, if it can move faster, that this would push whatever blackout they have planned to come sooner. And a blackout then triggers the bail-in, and that means money's frozen. We don't want to be in that circumstance. So it's a very important time to actually take some steps and make some changes. And that's why I'm doing this podcast this week about this. I think it's great that everyone is calm and that the market thinks it's over. It is not over. It has just begun. It might take another 18 months to fully come to fruition, but it also might take 60 days or 30 or 2 weeks or tomorrow. I have no idea, but once it happens, it's too late. So let's not waste any more time thinking, well, it'll be another who knows how long. Let's actually handle this while we can, because once the blackout occurs, the bail-in happens, we're not going to have any access to funds. It's going to be too late. So I take that to encourage you, forward this to friends, family, coworkers, colleagues, let them know this is reality, this is coming, and let's create a solid plan to deal with the challenges we know that our current system has given us, so we can be ready for this new system. That it's coming. This system is coming. And if you can't see that now, after everything that has happened recently, then, you just don't want to see it. And that's okay too. There's a lot of people that choose not to know what's going on and just to remain in the dark through a massive, global world interruption and disruption. And more power to those people. I'm just not one of them. I'm here sounding the alarm and getting you guys to take action. 866-92-WEALTH, 866-929-3258. You can also email us at info@WalserWealth. That's INFO @WalserWealth. Walser Wealth is WALS as in Sam ER, wealth.com, info@WalserWealth.com if you don't want to call. And we will get back with you. you guys, we are in the thick of it now. It is beginning. So do not rest on your laurels unless that's how you want to play this whole thing. For now, we will say goodbye. Take care, everybody. And until next week, I will see you on Crashes and Taxes. Take care.